Good evening and welcome to another episode of Night Markets. Financial markets close at 5 p.m. Night markets open at 6 to widen the conversation. Each week I'll be giving you my perspective on what's driving markets as well as my point of view as a family office professional. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research for South Africa at SFO. So despite the S&P 500 index experiencing its most severe weekly decline since March 2023 during the previous weeks, stocks were able to post substantial gains and essentially recovered the previous week's losses. Value stocks were significantly outpaced by their growth counterparts, which were bolstered by the robust performance of the tech sector. So starting off with markets in the US, the Labor Department's inflation reports were the primary focus of the relatively muted economic calendar for the week. The news that core consumer inflation, excluding food and energy, increased to 0.3% in August, which was slightly higher than consensus expectations, initially caused stocks to decline on Wednesday. Headline inflation also showed an annual increase of 2.5%, which is significantly lower than the 2.9% increase in July and the lowest level since early 2021. The macroeconomic data also indicated some minor glimmer of optimism for the struggling housing sector. The average rate for a 30-year fixed-rate mortgage decreased to 6.29% on Wednesday, the lowest level since Feb 2023 and lower than the 7.21% rate of the previous year. The Mortgage Bankers Association also reported that its index of home loan applications, which is the primary indicator of home purchases, has continued to increase since its August lows. During the week, the yield on the benchmark 10-year Treasury note also decreased slightly to reach its year-to-date lows. The Dow Jones Industrial Average lagged the more tech-heavy indices, ending the week higher by 2.59%, while the Nasdaq ended higher by almost 6% and the S&P 500 by 4%. Moving across the Atlantic to the Eurozone and the United Kingdom, for the second time this year, the European Central Bank reduced its deposit rate by a quarter point to 3.5%, in line with market expectations. The decision was mainly influenced in response to indications of declining inflation and economic expansion within the Eurozone. The statement that accompanied the announcement underscored the ECB's continued prudence and stated that the ECB is not pre-committing to a particular rate reduction path. Core inflation was revised marginally higher for the next 2 years as a result of stronger than expected services prices, while the updated quarterly forecast for headline inflation remained unchanged. Currently, the European Central Bank anticipates that the economy will expand by 0.8% this year, followed by 1.3% in 2025 and 1.5% in 2026. In July, the UK economic growth remained unchanged for the second month in a row as manufacturing output decreased slightly. Growth of 0.2% was anticipated by economists. However, inflation-adjusted gross domestic product increased by 0.5% sequentially during the 3 months ending July 31st. The labour market, however, appeared to remain constrained despite a slowdown in pay growth. For the 3 months ending in July, the average earnings, which exclude bonuses, increased by 5.1% from the previous year's levels. This is a decrease from the 5.4% increase we observed in the period from February to April. However, wages are still increasing at a rate that is nearly twice as fast as the Bank of England considers to be consistent with maintaining inflation at 2%. And then just looking at the markets, in local currency terms, the Pan-European Stocks Europe 600 index ended the week 1.85% higher, lifted by the interest rate cut from the ECB. Germany's DAX also rose by 2.17%, and the UK's FTSE 100 index added 1.12%. Then moving further east to the Asia-Pacific region, over the course of the week, Japan's stock markets experienced a fairly mixed performance, with the Nikkei 225 index increasing by 0.5% and the broader Topix index declining by 1%. Exporters encountered currency headwinds as the yen strengthened to the upper end of the 140 yen to the US dollar range, strengthening from the previous week's close of 142 to the US dollar. The currency moves were mostly driven due to a hawkish outlook from the Bank of Japan's Monetary Policy Committee. The most recent statements from the members of the central bank's board have bolstered expectations that the Bank of Japan will increase interest rates once more this year. Members of the Bank of Japan reiterated that the present level of real rates is extremely low, and the degree of monetary easing will be adjusted if the outlook for Japan's economy and inflation plays out as anticipated. In order to mitigate inflationary risks and preserve price stability, members recommended that the short-term rate to be increased to at least 1% during the latter half of the Bank of Japan's projection period through fiscal 2026. The yield on the 10-year Japanese government bond decreased from 0.86% at the end of the previous week to 0.84%, despite these hawkish comments from the Bank of Japan. This decline was mostly attributed to speculation that the Federal Reserve could implement a more aggressive 50 basis point interest rate cut at its September meeting, which pushed US bond yields lower. On the economic front, Japan's second quarter GDP growth was revised downward. The economy expanded by an annualized 2.9% quarter on quarter, which is lower than the 3.1% expected by the preliminary reading and market forecasts of 3.2%. The contribution from private consumption and capital expenditure contribute less than was anticipated. In August, the Consumer Goods Price Index increased by 2.5% year over year, which was lower than the consensus estimate of 2.8%, and a decrease from the previous month's 3% increase. The yen's recent recovery has also resulted in a significant decrease in import costs for the country. And then moving on to China, as a result of lackluster inflation data, Chinese stocks declined, raising concerns of a downward price wage spiral that could negatively impact the economy. The Shanghai Composite Index, as well as the blue chip CSI 300, both experienced a 2.23% decline. In August, the Consumer Price Index in China increased by 0.6% from the previous year, which was higher than the 0.5% increase we saw in July. However, this increase was below expectations, and we also saw core inflation, which excludes the more volatile food and energy components, increase by 0.3%, moderating from the 0.4% we saw in July. This is now the lowest level in more than 3 years. The deflation in factory gate prices that started in late 2022 continued with a 1.8% decline in the producer price index. The most recent data has now prompted calls for Beijing to implement more stringent measures in order to prevent a negative cycle of declining corporate revenues, wages, and expenditure, which many analysts believe is a threat to China's long-term growth picture. In August, exports surpassed expectations, increasing by 8.7% from the previous year compared to the 7% we saw in July. The expansion of imports in August was less than anticipated at 0.5%, which was also a decrease from the strong 7.2% increase we saw in July. And then coming back to the local markets, last week saw the latest mining and manufacturing production and sales data released by Stats SA. But despite the overall decline in mining, certain minerals, including manganese ore and chromium, experienced positive growth, increasing by 27% and 23.3% year over year, respectively. Mineral sales also surged by 24.5% year on year in July 2024, driven largely by significant increases in gold, which was up by 117.5%. And then on the interest rate front, traders are now anticipating that the South African Reserve Bank will decrease the repo rate by 25 basis points to 8% at its next meeting on September 19th, as a result of some of the slowing inflation numbers we've seen of late. According to a recent survey conducted by Reuters, 18 out of 21 economists anticipate the rate decrease, while the remaining 3 anticipated that it would remain unchanged at 8.25%. The median projections also now indicate that the SARB will maintain its gradual rate reduction over the next 3 quarters, culminating in a rate of 7.25% by May 2025. And then just looking at the local markets, the all-share index ended the week higher by almost 1%, as the resources sector ended higher by more than 3%. The rand also ended the week marginally stronger at 17.75% to the US dollar. And then just looking at the week ahead, so this week sees 4 significant central bank meetings that are scheduled, and it appears that none of them are in agreement on policy. The US Federal Reserve is anticipated to reduce rates by 25 basis points, despite the fact that we saw some rumors during the weekend that they could potentially cut by 50 basis points. Conversely, the Bank of Japan may surprise with another interest rate hike in response to their renewed hawkish stance. And although the Bank of England is anticipated to keep rates unchanged, a weak set of inflation figures could prompt speculation of a November rate reduction. Locally, the Reserve Bank will also announce their latest interest rate decision on Thursday, following the release of the latest inflation numbers on Wednesday. And then, as always, we'd like to end off with an interesting investment idea we discussed during the week. A few weeks ago, we commented on the possibility of increased volatility into the end of the year. We have started to see that play out a little bit. Locally, however, implied volatilities have continued to trend lower and overall are at close to the 0 percentile. We're looking at the data since January 2020. In fact, if we go back 10 years, we actually see that these levels were only lower briefly in January 2020 and at the end of 2017. And both of these periods were followed by significant volatility, so we believe it could serve investors well to hedge some of their equity exposure at these levels. Thank you for joining me for another episode of Night Markets. Financial markets close at 5 p.m. Night Markets open at 6 to widen the conversation.